everyone. I'm Allison Freeman, a realtor with the Premier Property Group located here on 30A. Once again, we're going to be answering some burning questions, busting myths, and separating fact from fiction. With me today is one of my favorite real estate tax gurus, someone who actually wrote the book, or two now, on real estate taxes and is an exceptional tax strategist, Amanda Hahn. Hi, Amanda.
Hi, Allison. I am so excited to be here. Thanks for having me.
Okay, so Amanda, my typical buyer is one that has vacationed here for a long time or maybe just found 30A and have fallen in love. They are looking to buy property here that they can stay in when they're vacationing and then rent out short-term while they aren't here. When thinking of ways for them to offset their cost of the property, they're mainly thinking about the rental income that they will receive, and oftentimes overlooking additional tax benefits that they can enjoy. What are some tax strategies of owners of short-term rentals can take advantage of?
Yeah, short-term rentals are actually one of our favorite tax-saving tools, especially for people who are of high income. So high income could mean like you're working a high W-2 job in the tech industry or in the medical field, or you just have high income from like a business that you own that's outside of real estate. And the reason we really like short-term rentals to offset that type of income is because unlike long-term rental properties where you have to, be a real estate professional to use the losses against these other income, for short-term rentals, we really don't care how many hours you're working at your job or spending in your other businesses. It's a much lower threshold to meet in terms of like the hours requirements and be able to use some of these tax losses that are strategically created to offset your W-2 or other income. And I always want to emphasize strategically created because in that sense, we're talking about like maximizing write-offs and maximizing your depreciation, not necessarily like actually losing money, right? Because the goal is always to have cash flow positive rental income.
So what I've understood is that you have to meet material participation. Is that correct? What does that include?
Yeah. So material participation, basically when it comes to taxes and short-term rentals, there's 7 different ways to qualify, but we'll talk about 3 of the most common ones. I would say 99 or almost 100% of our clients fall under one of these 3 categories. And you only have to meet one of them in order to meet material participation. So the first one is sort of like the gold standard, is you spending at least 500 hours on your short-term rental properties. As long as you spent 500 hours on the short-term properties, then we don't care about anybody else's hours at all. And when it comes to hours, it's not just your hours. If you're married, it also can include the hours of your spouse. And if you're someone with multiple short-term rental properties, you can also group them together too, so that you're just meeting 500 hours across all your rental portfolios. So that's a really good way to qualify. Another way for those of you who maybe cannot meet 500 hours, the other way to qualify is if you spend at least 100 hours on the short-term rentals, but nobody else spends more time than you. So the other people we're looking at most commonly are like the cleaning crew, the gardeners, the landscapers, the repair guys. So in that scenario, you're saying, how many hours am I spending? How many hours is somebody else spending? And then you arrive at whether you meet that second test. And the third test is you have any number of hours, but that's more than everybody else combined. So in our example, Allison had 60 hours. And if we added up the cleaning people, the repair guys, they added up to 20 hours, you still also qualified. So any of those 3 hours requirements would allow you to meet material participation. And why do we care? Well, we care because if you're a high income earner and you invest in short-term rental properties, you can use those tax losses to offset W-2 and other income.
If someone's not meeting material participation, are there still tax deductions that they can take advantage of with owning a short-term rental?
Yeah, for sure. I mean, all short-term rental operators and even long-term rental operators, regardless of how many hours we're spending, we all get the same types of tax benefits and deductions, meaning we can all take depreciation. We can all do accelerated depreciation if we wanted to. We can all take expenses on our properties, and not just like interest and property tax, but you can also write off like your trip to go and work on the property. Or if you have a home office that you're managing your properties from, right? You can write those off. If you're driving your car for real estate, if you are using your computer for real estate. So those are deductible regardless of whether you meet the material participation or not. The only difference in the hours is determining if we had a loss at the end of the day, what kind of income does that loss offset? Is it just offsetting my rental income, or does it also offset my W-2
income?
That's the only difference.
Okay. Yeah. So you mentioned accelerated depreciation, which is also known as cost segregation. Is that correct?
Yes.
So It's my understanding that you can only take this once on a property. Can you explain a little bit about what cost segregation is and when it should be used?
Yeah, so, cost segregation, you hear investors talk about that a lot. So cost segregation basically is a way for us to accelerate depreciation. So when you invest in rental real estate, you're going to depreciate the property over time. So usually it's either going to be 27 and a half years or 39 years, depending on the type of the property. But cost segregation basically is a way that allows us to go in and look at the building and say, it's not just building, it's actually made up of a bunch of different components. And with the different types of components like furniture, fixtures, things like equipment, we can then take faster depreciation. So we're not creating additional deductions. We're just accelerating what we would otherwise be writing off over many, many years into as much as possible this year or the next couple of years.
So once someone has purchased their short-term rental, I find that sometimes they want to make repairs or refurnish it or maybe even remodel. And I know that one tax strategy that buyers can use for these items is depreciation, like we were just talking about. Can you tell me a little bit about how owners of short-term rentals can use depreciation and bonus depreciation to their advantage?
Yeah. Bonus depreciation is something that came out a couple years ago. So in a normal scenario, what we just talked about with the cost segregation, instead of depreciating something over, let's say 27 and a half years or 39 years, we're trying to write it off faster. So maybe we'll want to take it over 5 years or 7 years, whatever the law allows us to do. Right now we have bonus depreciation. Bonus depreciation just means instead of having to write off over 5 years, we're actually going to write even more of that off sooner rather than later. So 2023 right now, bonus depreciation is 80%, which means if this was a $10,000 thing, I can write off $8,000 immediately as bonus. The remaining $2,000, I'm still going to write it off over like 5 years or 7 years or 15 years. And so that's a really powerful tool, right? Because we were just talking about, traditionally when you buy rental real estate, we get this wonderful thing called depreciation. Mm-hmm. And then on top of it, we can do cost segregation, which is accelerating that depreciation to now. And then the third layer is not only are we going to accelerate it, but we're going to take bonus on top of it. So we're getting like as much as possible in that first year. And so when you hear investors talk about like, oh, I bought a short-term rental property and then I offset $100,000 of income from my taxes, most of the time it's because they're using these sets of strategies kind of in that order to get that big benefit. Typically, and hopefully it's not because the property actually lost $100,000.
Okay, so as I mentioned earlier, a lot of my buyers also want to use their rental property when they come down here. So is it fact or fiction? I can't use my short-term rental for personal enjoyment and take tax deductions.
Yeah, that's a really great question. We see that a lot. What we see is like with investors, especially investing in short-term rentals in places where are beautiful, that they would love to go there in the summer, in the winter with their family. Obviously the consideration is, hey, I'm going to make money from this and also have some personal enjoyment. It's really important to really be careful and kind of strategize ahead of time, because there certainly are instances where if you have too much personal use, then your tax benefits become very, very limited. So in the short-term rental space, or I guess any property really, if the personal use days are greater than 10% of the business days, then those sort of become, a personal and a rental. And the downside of that is, although you can still take deductions and depreciation to offset the rental income, you can no longer create a loss to offset other business or other W-2 income. And the reason for that is basically the IRS looks at it as if it's partially your property, right? So like if Amanda went out and just bought my own vacation home that I'm going to hang out there, I don't get to take depreciation. It's not a business asset. So two important facts here. When we say rental days, it's not just the days that it was advertised for rent. These are days actually occupied by the guests. So we have some people who are like, well, I'm just going to advertise it for super expensive. No one's going to rent it and I'm just going to use it all myself. That unfortunately is not going to work because then you don't have true guest stays. And then the other part that I think people are often confused about is personal days are days that you're there for enjoyment. They do not include like days you're there working on the property. So let's say that you went to Florida and you're like, hey, I'm going to work on my rental properties this weekend or this week. Those are perfectly fine because those are actual business days that you're working. You're there to like set it up or deal with any repair issues. So something very important to keep in mind we see investors miss.
Okay, so another thought that I had is sometimes people will purchase a property towards the end of the year and it doesn't get on a rental program until the following year. And they may have purchased furniture and repairs and those sort of things in the prior year that it's on the rental program. So how does that work for taxes? Do they still get to claim these deductions next year or?
Yeah, so if you bought a property towards the end of the year this year, but you don't actually put it into service until next year, what happens is all of the expenses you had this year, you don't even report them on your tax return. They carry over automatically into the following year. So in that second year, when the property is now put into service, right, we got tenants or guests coming in and out, that's the year when you start to take depreciation or expenses on that property. So you don't get to lose the deductions from year one. It just carries forward into year two to then allow you to use it. And that's one of the reasons why we tell clients, when you're getting really close to the end of the year, try to put it into service if at all possible, because then you can kind of accelerate that benefit rather than having to wait a whole year.
So Amanda, what's a common mistake that owners of short-term rentals typically make?
I wouldn't even say it's like a common mistake made by the investor, but I can say probably the most common tax mistake made by CPAs or tax advisors is not understanding the short-term rental loophole. We were talking about the fact that for short-term rental investors, we don't have to be a real estate professional. You just have to meet one of those material participation roles. But unfortunately, because the tax code is so complex, so there's not that many CPAs who work in real estate. And then within real estate, then we kind of drill down into the short-term rental loophole. So one thing to be careful of, if you're someone investing in short-term rentals, you're trying to use this strategy to offset taxes from your W-2 income. Make sure when you talk to your tax person that they understand that you do not have to be a real estate professional to use short-term rental losses. That's not relevant. That only applies to long-term rental properties. So if you're getting pushback on like, hey, you're not a real estate professional, you don't get any benefit, make sure you have them look into the short-term rental tax loophole, because that's when we see missed more often than we would like.
Wow, Amanda, that was a goldmine of information. Thank you so much for joining us today and for helping us shed light on the rewarding tax strategies associated with owning a short-term rental, particularly here on 38. And for anyone else of you who want to stay up to date on the latest real estate tax strategies, I encourage you to not only follow me, but also follow Amanda Han. Can you tell us where everyone can find you?
Yeah, for those of you, if some of the things that we talked about, if they're brand new to you, like the short-term rental loophole or depreciation, or if you just want to know, how do I pay my kids and get a write-off, you can just visit our website. It's keystonecpa.com. And we have a lot of great information, and we have a specific tax tool just on short-term rentals. And for those of you in long-term rentals, we have a specific one for that too, because it's different. So yeah, keystonecpa.com if you want more free education. Like Allison said, I also have a book called Tax Strategies for the Savvy Real Estate Investor. You can get it on Bigger Pockets, Amazon, Barnes and Nobles, anywhere books are sold. If you just want daily tidbits and tax tips, best place to find me is on Instagram. I am Amanda Han CPA.
Thank you, thank you, thank you, thank you so much. And again, until next time, bye for now.